everyone. It is Sunday, May 30th. We are celebrating Memorial Day. So thank you for your service for all of our service members out there. And this is episode 15 of Odds Are, your S&P 500 weekly market forecast. All right, let's jump right in. Let's take a look at last week's forecast. All right, you can see that we breached the upper breach point, in fact, 3 times. And then on Friday pulled back down below it to settle at 42.02. So that was the closing price, just below that 42.09 breach point. We stayed within the expected settlement range. We did not come close to the lower breach point or settlement limit, or definitely not that parabolic SAR down there at 40.13. Let's look at the moving averages now. We have now come full circle back to a bullish short-term moving average. We have gone from bullish to neutral to bearish, back to neutral, down to bearish, back up to neutral, and now we're back up to bullish. So it's been all over the place. But interesting, throughout this whole time, the medium-term moving average is kind of held on that bullish note, and the long-term moving average obviously is still very bullish, which, you know, when we're looking at these cycles, we've already talked about how it will turn in those different phases, where the short terms will have that rollover first, then the medium, then the long term. We have not yet gotten out of that pattern. We are still in the short term phase of that. The interesting thing is going to be when that medium term flips, and then whether or not that actually extends down into the long term. But getting ahead of myself. All right, let's take a look at this coming week. It will be a short week, but still the numbers hold true. We are looking at a 41.58 lower breach point and a 42.33 upper breach point, with a 81.39% chance that we will have a breach of one of those two levels. All right, let's add in the settlement range. So we're expecting the market to settle between 40.88 and 42.77 by the end of the week, with 79% odds of that occurring. And we'll add in the parabolic SAR now, which is now at 40.36. So getting closer to the expected settlement range. Again, it'll get interesting when that actually comes above the expected settlement range, or definitely if it's above the expected breach points. That's when things really get interesting. But if we do close below that 40.36, that is obviously a very bearish indicator, and that may be the trigger that sets us off into that parabolic market that we were talking about last week. All right, let's roll all these together, and now you can see where they are in relation to the price action over the last couple of weeks. Interesting thing to note here, take a look at the upper breach point, how that lines up nicely with the top of the Bollinger Band, which in this case would act as like natural resistance. And then look at how the 41.58 lower breach point lines up close to the midline, which tends to have more of a pullback effect. So when you're reverting back to the mean, depends on what that mean is. In this case, if you use the midline, the market will go up to the top of the Bollinger Band, then come back down, hit the midline, go below it, revert back up. It doesn't always happen that way, but in this case, if we were to pair these two sets of indicators together, so our breach points and the Bollinger Bands, then we would be looking at resistance at the top, the upper breach point, 42.33, and more of a magnet effect pulling it back down to that 41.58. And then again, look at how 40.88, the lower settlement range, lines up with the bottom of the Bollinger Band, so providing that support there. So my call for this week, I say we're going below the 41.58 level, and we're going to see some support at the 40.88 level. Doesn't mean we're going to get right up to it, but I see the market getting down between that 41.58 and 40.88 levels at some point in the next week. The 40.36, I don't see that getting breached, but very well could. Again, we've kind of gotten into that pattern where we're just trying to find direction. We're still just kind of hovering. Really, if you go back, you know, you can see that we've just kind of been in this choppy market for about 3.5, almost 4 weeks now, really, and nothing's really broken one way or the other, which eventually it will. All right, let's take a look now at the section we call Didn't See That One Coming. And I'm going to actually now introduce the quote of the week, because the quote of the week actually ties into what I'm saying we may not see coming, or at least some of us may not see. All right, so the quote of the week is, "Sell in May and go away." And it's said by they. Why? Because I have no idea who actually said this, but they say sell in May and go away. So whoever they may be, this expression gained popularity because investors felt that it was best to take their money out of the market during the 6-month period between May and October. Now, there's a couple of different psychological reasons why this may be the case. One theory is because people go out on vacation, and so they're not actively trading, and so you got people that are engaged normally in market activity stepping away and taking some of that liquidity with them. The other idea is that people are holding back and waiting for that kind of end of year boom when everybody's shopping for Black Friday, Thanksgiving, Christmas, during that time. It's a real boost to the economy because there's so much spending. Whereas in the summer or summery months, right, people may be traveling abroad, and so actually providing that liquidity or adding that money to other countries as opposed to stateside. But that's a very small part of it. I don't think that's the whole picture, just a little background as to like where this came from. And so what I'm going to do actually is I'm going to challenge you guys to double check my work, right? Because I'm going to go out there and say that from what I'm seeing over the last 5 years, this has been complete nonsense. In the last 5 years, sell in May and go away has not worked. In fact, the average return for the S&P 500 has been over 4.5% when you look at those 5 years. And in all 5 years, we were positive between May and October. So that's the data. Now, here comes the contrarian view. Here comes the devil's advocate. Are we at the point where after 5 years of having proven the sell in May and go away theory wrong, are we actually going to get a year where we're going to have negative returns between May and October? Something to think about. I'm leaning more towards yes. I'm thinking we are going to have a negative performance between May and October in this year, and that we are not going to have 6 straight years of positive returns during the sell in May and go away period. But I guess we'll come back and see, right? So if I forget to bring it up, please go ahead and leave me a comment sometime in October, early November. Call me out on this. I'll definitely try my best to make sure I bring this up again so we can review this forecast. But until then, let's just worry about the week ahead. Enjoy your extended weekend. Thank you again to all of our service members, and have a great week.